Thank you again very much for attending today's webinar. I trust everyone's had a chance to read the risk warning at this stage, so let's move swiftly on. Top 5 trading mistakes. Apologies, I meant to say to anyone who tried to attend this last time, so I think this is the second attempt at trying to get this webinar going. This time it's successful, he says. So obviously there are all kind of mistakes you can make in trading, and we're all different obviously. We all do things slightly, we do the right things differently, do the wrong things differently, but there are some core things that we tend to do over and over again, which can cause us some issues. There are some common mistakes that we all tend to make. Maybe we don't make all 5, but we make a good few of them. So here they are. I'm just coming right out in front with those mistakes. Trading too big, over leveraging. Obviously CFDs and spread betting are leveraged contracts, and so there's an additional possibility of trading positions that are really just too big for your account. This is not exclusive to CFDs and spread betting. Though, trading any kind of market, you can trade a position which is too big a proportion of your overall account size. You know, for example, you have $10,000 in your account. You buy one stock with all the $10,000. It's back to that old putting all your eggs in one basket idea. You've basically traded too big, even though you had the $10,000 to lose on that trade. In my view, you still traded too big because you're putting all your eggs in that one basket. If that one trade goes wrong, you know, you're taking a disproportionately large hit. Of course, if it goes right, fantastic, but the risk really isn't worth the reward on that. Setting stop losses badly, easy to say, right? Of course, you want to set stop losses correctly, but there are some kind of common things that people tend to do. Putting them much too tight, assuming the accuracy of the trading systems that just don't really exist, and also just not having a stop loss. You know, we've all been guilty of that, but it really is quite suicidal not to have some sort of risk management in place should things go awry, which they frequently do. Over trading, FOMO, is quite a common phrase these days, especially on social media, the fear of missing out. So that is a common reason for over trading, for placing too many trades, is that you see the market moving all the time and you just want to be able to take advantage of every opportunity there. But you know, you've got to try and restrict yourself to a certain set of criteria to keep yourself disciplined, but it can be difficult to do so. Especially, as I said, in the world of social media, if you are following the news in terms of trading, you can see what other people are doing and you kind of want to try to jump all over the place, but really you need to stick to what you do best, or learn to know what you do best. Switching strategies, a similar idea, basically, and again, all of these I'm going to go into in more detail on the next few slides. I hear Simon is saying he only has the sound. Okay, now he's back online. Brilliant. All right. Switching strategies. So basically, especially when you first start out, how do you know the best way to go about trading? Well, you don't, obviously. You've got to try different things. So this is slightly counterintuitive. You would think, well, I've got to try one thing. If that doesn't work, try something else. That is logical. But you've got to understand the definition of what trying it properly is when it comes to trading. Placing 5 trades, all of which turn profitable, then the next 5 are losses, and then giving up on the strategy doesn't constitute a decent test of that strategy. Actually, you know, there's plenty written out there. We're increasingly producing a lot of material ourselves from LCG on some pretty standard techniques that people use to make money trading the markets. So you don't have to reinvent the wheel here. There are strategies that are proven to work. You just need to make them work for you, and you need to give them the benefit of some time and practice to actually get them working. If you don't give them that time, you'll just bounce from one strategy to the other. trading against the trend. This is a bit more technical, but really if the market is soaring higher, the chances of you catching the top are much smaller than the chance of you just buying into that momentum and it keep going higher. The top only happens once, but continuations happen a lot of times. So let's dig into some of those ideas in a bit more detail. Trading too big. We've said this already. Obviously, everyone knows that the bigger you trade, the bigger your potential profit, but the bigger the losses too, obviously. The obvious caveat to that. So the problems. What if a trade doesn't work? Obviously you've placed a huge trade, but it doesn't pan out as you expected. What do you do then? You have there are statistics that I'm not detailing in this particular presentation, but basically the idea is that if you say, for example, you lose 20% of the value of your account, you don't need to make 20% in profits to regain that lost 20%. You need to make closer to 30%. So making back the losses is that much harder, because the logic being that your account is smaller after that large loss, it's that much harder to recuperate it, to recoup it. So you really want to try and keep the losses to a minimum, as they always say, and let the profits ride. The other issue is that a lot of the problems with trading, as I said, many of these strategies have been around for decades, proven the test of time, but it's just our own emotions that get the better of us and make sure we don't actually follow these strategies to the letter. And when you're placing trades that are too big, it adds a bit of psychological pressure, and the typical result of that is you start making bad decisions. So, for example, you place a trade that's too big, the trade shoots straight into a profit. Suddenly, lucky timing, it jumps 10 points higher. Suddenly, you've made actually a sizable return on your account. So you think, actually, I'll just take that. My plan was to take 100 points, but actually, I've got a quick 10 points here, so I'll grab that because it's such a maybe there's such 20% return on my account or whatever the case is, and you claim it. So when doing so, you obviously haven't actually followed through on your strategy to take 100 points. So what can you actually take away from that trade? Basically, you just got lucky. Counter to that, if you're placing a trade that's too big, and you had a planned stop loss size of 50 points, suddenly it crashes 10 points against you as soon as you get in. You think, my God, I can't weather any more of these losses. I know I planned on 50 points, but actually I'm just going to jump out straight away now. And then the market drops another 10 points and then rides up to your planned take profit area. So you obviously haven't executed on your plan, because there was that extra pressure on you because of the size of the trade. That wouldn't likely be there at least as much if your trade was, if the resultant profit or loss was a smaller value of the percentage of account, and so had less overall meaning for your profitability. And then just a pretty straightforward maths point we've kind of already emphasized here. If you risk 50% of your account on every trade, you can only afford 2 losses, and that's all your money gone. If you risk 10%, you can obviously afford 10 losses, and so forth. So you're just giving yourself that much more wriggle room. We're going to do another webinar later on building a trading strategy. One of the statistics you follow is percentage drawdown. There will just be periods when your strategy doesn't really work. If you've got a trend following strategy, range bound periods in the market, if your strategy is to keep placing trades even as the environment changes, will inevitably go through a period of losses, but that's just part of the strategy. You have to weather that drawdown to then wait for the good times to reappear. So some solutions to this. Obviously, we probably are all a bit familiar with those problems, but solutions. 2% rule. Anyone heard of that? basically just risk 2% of your account every time. This really is, for me, the golden rule when it comes to money management. You don't have, there are all sorts of ways of going very scientific on risk management, and sure, if you've got the time and ability, do that. But ultimately, if you risk less than 2% of your account on every trade, that keeps you pretty safe. It really has to be a pretty epic string of losses where there is something fundamentally wrong with your trading strategy, or at least the way you're executing it, should you wipe out an account if you're only risking 2% each time. After breaking a rule, take a break. This is certainly something I do. If I get tempted into a trade that I hadn't really planned on, hear some news, get kind of tipped into something, and it doesn't work out, take a break from trading. Obviously your psychology is not obviously where it should be. You're being undisciplined. There's a phenomenon where you make a silly loss and then you try to chase that loss back with some quick gains. And typically those quick gains that you try to make come from a bad decision as well. So it's better actually just to take a break. If you're really disciplined, take a break even if you broke a rule and the trade worked out. And lastly, can't afford multiple losses, well, at least just set a stop loss. Any questions, obviously, on this as we go along, certainly feel free to jump in there. So setting stop losses badly was the second point I believe we had on our list, was it? It was. Okay, so not having a stop loss, the first thing we need to address here. We've all said this at some point in time, and in some levels it makes sense, but actually I've got some reasons here why it doesn't really make sense. This trade is a surefire winner. You just feel it, everything's lined up perfectly. There's a confluence of all sorts of indicators. All your favorite gurus are suggesting the same thing. Whatever the case is, the trade looks perfect, as perfect as it can get. It's still about a 50-50 chance. That's the nature. The one thing to get your head around in trading is the next trade is about 50-50. What gives you a winning edge is your performance over 10, 20, 50 trades. It's guessing the result of the next one is almost pure chance. So do you want to actually risk not having a stop loss in a trade which could go wrong? Because if you don't have a stop loss, then what are you going to do when that trade in fact isn't the surefire winner you thought it was? Not trying to be negative here, obviously this is just the reality of trading. There are losses, it's just you manage them and make sure you're in the game for the winners. I like to stay flexible. It's something I've heard a lot of times. This sometimes comes into concert with the sort of the idea of maybe having a sort of manual stop loss. I'm not a fan of having a manual stop loss, i.e., when you decide a price level, when the price gets there, you manually close yourself out rather than having something automated set. Just opens you up to, again, the emotions of when the market's moving. When you're watching a market live, you might find yourself thinking, well, it looks like it's going to turn around soon, or something along those lines, or the market suddenly dips close to your stop loss and you think, oh, let me get out and save myself a few dollars, when actually where you'd originally placed it was the correct place in line with your plan. Maybe the market turns around just after you got out early. And then this really is the ultimate excuse for not setting a stop loss. The market will stop me out and then turn around and go back to my take profit. That unfortunately can happen a lot of times. But if I move through to my my kind of reasons why this doesn't make sense, yes, it sometimes will do that. You could say that obviously the market doesn't often just power in a one direction. It often moves back and forth, and eventually you would think that at least half the time after getting stopped out, the price will probably make it to your take profit area before it goes a similar distance in the other direction. But the point is, if you don't have that stop loss in place, there are some times when the market just goes on a prolific trend counter to the direction you thought it was going to go, and that not having a stop loss in that one occasion will wipe out any benefit from all those occasions where it turned around and went in your favor. So just for that, for that 1 out of 10 occurrence where the market really keeps rocketing and just doesn't come back, it's worth it to have the stop loss and be stopped out, on those other occasions when you didn't quite time it. And all right, Simon's just got a question here, so let's deviate towards that. Question being, if we trade in day-by-day trading, stop loss is necessary, question mark. If we trade a day non-stop, we could take the risk because we realize immediately and change strategy. I mean, I guess the point is you basically, whether it be a mental stop loss or a physical stop loss in place, it may be that you have a trading strategy where there's an indicator that tells you to be, that always basically keeps you in the market. So if you have an indicator that tells you to go long, your reason for exiting that long trade may be a signal to go short. So in that case, obviously you've got kind of the market as or an indicator as a signal. It's not personally the way I trade, just because I think it's difficult to control your risk to reward when you're not directly planning your entries and exit via the price. But in that instance, I can understand why you don't necessarily need a stop loss. You're just flipping from bullish to bearish all the time in a day trading scenario. From my experience, though, still the best day traders do have at least a mental stop loss where if the trade goes sour by a certain amount, cut out, and they can always get back in again should it start to look better again. And then lastly on this issue of the stop loss, I hope that makes sense, Simon. On the last the last point about stop losses, there are people who leave stop losses to be too loose, but to be honest, in my experience of talking to clients over the years, that's rare. Mostly they put the stop loss too tight, which is sort of an opposite idea for not having a stop loss, right? It's scared of making the loss, and the logic being, well, let's just put it a few points away, and if the market is wrong, I'm quickly out, and I don't have to worry about that huge loss. The point is that these are the kind of market timing tools that we use, technical indicators, news events, etc. They're not perfect. They need some wiggle room. And so what happens if you consistently have your stop loss too tight is you just get what they call shaken out. There are professional traders, market makers, etc., whose specific strategy is actually to work out where people likely have stop losses and try and shove the market in that area just to get people worried enough to shake them out with a small loss. And that little small loss for those people with too tight a stop losses is the profit on large trades for these big traders. There are some sharks out there that you have to be worried about, and that's why as a retail trader you've got room, you can afford to have a slightly larger stop loss and give yourself just that room to breathe. So over trading. Some common reasons for over trading. Again, over trading just being placing more trades than you really plan to, I suppose, is probably the best definition of it. Your trading strategy may mean that you place 100 trades a day. Over trading might mean that you placed 150 or 200. If you're planning on placing a couple of trades a week, obviously suddenly placing 10 trades in a day, that's your over trading there. Understandable why it happened. There are just so many opportunities, particularly with a company like LCG, covers so many markets, all of those markets moving. There's always something going on, and there's a desire just to catch them all. again, that FOMO. But the way you can kind of control this is by having a more defined trading system. You've got to have a plan where I trade X markets. Now, that could be a wide range of markets. It could be a very narrow select few markets. And I trade at a certain time of day and I trade a certain strategy. There's got to be certain bullet points that constrain the kind of trades that you place. So if there's suddenly an earnings announcement that comes out and it sounds really good and everyone's jumping in, but you don't have any trading strategy that pertains to earnings coming out, well, don't place that trade. It's not within your trading plan. Don't have that sense of FOMO because your trading system's well defined. That system is what makes you your money. So don't suddenly jump into things that aren't part of that money-making system. And obviously boredom can be the other thing, especially if you are full-time trading. You're waiting for your particular setup. You're stuck in front of the screen. It's a boring day on Twitter. You decide to place a trade just for the sake of it, for a bit of excitement. That is understandable, but again, the way to try and get around that is, again, a well-defined system. You can do that by having a checklist of things that you need for your trade to be valid. This could be printed out and something you tick each time, or this could be just something on your screen in an Excel sheet, but a bunch of criteria as to what makes your trade valid. Have that in front of you, and if you look at that and then still place a boredom-based trade, well, that can happen, but it's a lot less likely to. And maybe you'll be a bit more aware of what you're doing in a trade, or at least be smaller or something. Something else you can do is just create a trading routine that just suits your lifestyle and doesn't allow that boredom to creep in. If you do find you're someone who's easily getting bored, make sure there's some room in your routine to actually get away from the screen, do some other things away from trading that keep you interested, and come back with a fresh perspective when you're back on the screen. Of course, you might miss a trade or two, but it will avoid that risk of over trading, which will, I'm sure, more than offset any missed opportunities. And I've said at the end here, take only the very best opportunities. Easily said, obviously, but the idea being your trading system, unless it's completely automatic, is going to have an element of kind of perception within it. And if you can, over time, get a feeling for what is the most likely trades to work out with the best, say there are 3 indicators you rely on, and only take trades where the 3 out of 3 line up rather than just 1 out of the 3, that kind of idea, then I think you're setting yourself up for less chance of overtrading. Switching strategies, we talked a bit about this at the start, so it's a tricky idea to get your head around. I mean, it is a vicious cycle for beginners, especially when it comes to trading, because you need some successful trades to gain confidence, but you need the confidence to trade successfully. So, which comes first? In my experience, the best way of getting around this is just back testing a strategy, going back through the charts, and then forward testing it with firstly a demo and then a smaller trading account. Reasons for switching: losses. Basically, the main idea is that losses cause a trader to lose confidence in their trading system. Understandable, right? You're not in this trading game to lose, so you try something else. But what you got to understand is that there are some trading strategies where you only win 1 out of 20 trades, but that one winner is so huge it offsets the other 19. Obviously, if you tested that trading strategy across 10 trades, most likely those 10 would be losers, and so you'd move on. But that's not a sufficient test for that strategy. It's an extreme example, but it just goes to show that you need to give these things a proper go before you move on. Find something that makes intuitive sense to you, that it's shown elsewhere by someone else successfully trading it, that that it's a winning style of trading, and then just give it a serious go before you finally decide, yes, this is great, I'm making money, or okay, no, it's not for me, then move on. It's obviously a bit of a grey area. When do you decide to move? Again, might be something more part of a kind of systems development webinar. What is the historical drawdown of this trading strategy, and what is your current drawdown? If the strategy from what the testing you've done suggests that you should only lose at the absolute most 30% of your account in a drawdown before you then from the top of the account value, say you've made 50%, but then you have a sudden drawdown of 30%. If your strategy suddenly, the way you're trading, suddenly you're down half your account, maybe that's the time when this strategy isn't acting as it should do. Something's going wrong and you have to move on. Again, there is, it's something also to be it depends per strategy. It's something you kind of have to line out for yourself before you even get going. But the key here, I think, is just don't quit randomly. Just because you see something else someone else is doing and think you give that a go. Give the trading, research the system you want to do well to start with, feel confident in it, and then give it a good go. And I mentioned at the bottom here, give a system at least 20 trades of following the rules exactly, ideally 50 trades of following the rules exactly. So not breaking the rules 10, 20 trades, but actually, properly following that system for 20 or 50 trades. I think this is the last point that we're making here. Last, potentially even the best till last here. I, for myself, am a trend following trader, and so really just not a big fan of when markets are moving sideways. The best traders out there, and one I hope to be one day myself, is one who can switch from a trend following strategy to a range bound strategy as the market dictates. But it's a hard skill to capture, but at least what you need to be able to do is identify the market environment, and to ideally, as soon as you possibly can identify that change, stop the wrong strategy for the environment. So you can see quite simplistically in these two charts, and you may recognize them. I've created them for numerous webinars now because they fit so many points, but simple breakout strategy in a rising trend works pretty neatly, but obviously that would be a complete mess in this trade on the right. Actually, just selling within 20% of the recent highs, buying within 20% of the recent lows works pretty well in a range-bound environment. And two very simplistic systems, but good examples of trading the right system for the right environment. And obviously just not in this left-hand trade, not trying to sell the market's rising. Is very, very difficult to do, but once you master it, always going to be situations like we see a big reversal and you think, oh, I picked the top. Even today, I made a chart on TradingView and also did a quick YouTube video on a potential double top pattern in the NASDAQ. Well, I cautioned it saying I'm not a seller. It's just I'm appreciating that there's a bit of divergence in the indicators. NASDAQ's had a big run up, seems to have shown a couple of reversal candlesticks up near the old record highs, potential for a double top here, but still not selling it because the trend is higher. Right, that is it. We've hit the half an hour mark quite nicely, so I think we'll just kill things off here. Certainly feel free to follow me for more information on Twitter and TradingView and Facebook and YouTube, and I hope to see you in one of the next webinars we do. All right, thanks everyone. Good luck with trading today.